For the gross profit, like I said earlier, we get our gross profit. I just stop that already, please. Our gross profit is derived from taking away the cost of sales from the revenue. That is done. As soon as we have our gross profit, the next thing we have to calculate is our operating profit. And how do we get our operating profit? Operating profit is gross profit less operating expenses. These are the two operating expenses we have. The selling expenses. Now, when we talk about selling expenses, we're talking about the amount we spend to ensure the product is being sold. Not producing the product, ensuring that the product is being sold, probably for marketing, advertising. All these are selling expenses. Do we understand? Commission paid, they are all selling expenses. And for administrative expenses, we're talking about the administration, the office expenses, maybe stationery, wages is being paid, equipment is being used, and the rest. They are part of expenses. So you take your operating expenses from the gross profit. That gives you your operating profit. So operating profit, now we know operating profit, right? Operating profit is gross profit less operating expenses. Is it clear, please?
Yes.
Gross profit is cost of sales, revenue minus cost of sales. We have gross profit. For operating profit, it is gross profit less tax. Then we have to go to the profit for the year. How do we get the profit for the year? The profit for the year is derived from taking away the finance cost. Why do we call it finance cost? We call it finance cost because this amount of money is being paid based on the loans we take from the bank. As soon as you take a loan from the bank, you have to pay interest on the loan, right? So the interest you pay on loan is part of your finance cost. You have to take it away from your operating profit. And sometimes we might have finance income. What is finance income? Finance income is the interest we get from saving our money in the bank. That is finance income. As soon as you have, can you just stop that already? As soon as you have your finance income, you add it to your operating profit. You don't less it from your operating profit. You less finance cost from operating profit. You add finance income to operating profit. Do we understand the point I'm making here? Yeah. Finance income is added to the operating profit because it's an income. Finance cost is deducted from the operating profit. Is it clear, please? As soon as that is done, we have our profit for the year. The profit for the year is the profit made by the business after all deductions. But remember, we have to pay taxes. Taxes are based on the percentage of our profit. So that means taxes will be the last thing we calculate because tax is based on the percentage. Do we understand this? So as soon as we do that, we have our net profit for the year. So this is how a statement of comprehensive income is being prepared. Any question about this?
No.
Great. So we go to measuring profitability. The profitability of a business is measured through these statements. This is what we use in measuring the profitability of a business. That means how profitable the business is. So I wrote, the profitability of a business is measured with an income statement, which is this. There are three profit margins that can be calculated. The first one is the gross profit margin. Here we have our gross profit, right? These are our gross profit. Yes or no, please? Yes. Great. So to get our gross profit margin, it is gross profit as a percentage of the revenue. Gross profit as a percentage of the revenue. That's what it is. Gross profit margin equals gross profit multiplied by revenue divided by revenue multiplied by 100. Do we understand gross profit margin? Gross profit margin, the formula is gross profit divided by revenue multiplied by 100. So a high gross profit margin is preferable than a low gross profit margin. So how do you increase your gross profit margin? To increase your gross profit margin, there are two things you could do as a business. Number one, you find a way to increase the price of the product in relative to the cost of sales. So if the price of the product is increasing ahead of your cost of sales, it means your gross profit margin would increase. You have a higher gross profit margin. So here I wrote, by raising revenue. To raise your revenue, you have to raise your price. To raise revenue, you have to do what? To raise your price. So if you are able to raise your price ahead of your cost of sales, you are expected to have a high gross profit margin. Do you understand the first one here, please? Do you understand or not?
Yes.
The second one. Pause it. Yes.
Pause, okay.
Alright guys, so that's for the gross profit margin, which is done. Then for the net, okay, the other way to increase your gross profit margin is by finding a cheap supply. You know, it's about your cost of sales. Your cost of sales comes from your suppliers. If the cost of sales is increasing, it means your suppliers are increasing their prices. Yesterday we talked about the variances. And when we talk about variances, it means the difference between the actual and the estimated cost or the estimated outcome. So most of the time we have a high cost variance because and which is an adverse one, which is a negative one, because we are buying from suppliers that are selling at a higher price. If your suppliers are selling at a higher price, it means your cost of production will increase, which means your cost of sales will always increase. But you want a high profit margin, gross profit margin. So for you to get a high profit margin, it means you have to start looking for suppliers that can sell at a cheaper rate. If you are able to get that, it is expected of your gross profit margin to increase. So to increase your gross profit margin, number one, you can increase the price of your product, but mostly, if you have to increase the price of your product, it might mean that the demand for your product is always priced inelastic. If not, it will be difficult for you to increase the price of your product. The second one is to find a cheap supply, because if you are able to find a cheap supply, it means your cost of sales is expected to fall. Then you'll be able to have a high gross profit margin. Then the next one is operating profit margin. For operating profit margin, it simply talks about your operating expenses. You are taking away your gross profit from your operating expenses. So to increase your operating profit margin, you have to find a way to reduce your operating expenses. As soon as you are able to reduce your operating expenses, use less papers, reduce the wages, find a way to be efficient. If you are able to do that, it is expected that your operating profit margin is also increasing. And the last one, so operating profit margin is operating profits divided by revenue multiplied by 100. The gross profit margin is gross profit divided by revenue multiplied by 100. Operating profit margin is operating profit, which is this, divided by revenue multiplied by 100. I talked about that. And the last one is net profit margin. For net profit margin, we're talking about the bottom line. That's the last profit that can be made. So I wrote, the net profit margin is net profit before tax, net profit, this profit before taxation. Get the point here. For your net profit margin, it is net profit before tax. Tax will be paid as a percentage of your profit. So when you're calculating your net profit margin, it should be calculated with the net profit, this profit, before the taxes, divided by revenue multiplied by 100. Notice board. A higher net profit margin is better than a lower net profit margin. Why? Because the net profit margin focuses on the bottom line. I want to talk about the bottom line of the business. We're talking about the last we could talk about in terms of the profit made by the business. So I wrote, the bottom line refers to the very last line in the statement of comprehensive income. This shows the profit after all deductions are met. That is the amount left for the owners of the business. So this is the amount left for the owners of the business, which can either be distributed to shareholders or retained into the business. If it is retained into the business, it goes to your statement of financial position, which is the last line of our financial statement. Do we have any question? Question? No. Yes, sure.
I don't understand the table used.
This?
Yeah. What does the X's mean?
These ones are just formats instead of figures. Normally we're supposed to have figures, but this is just a format in representing the figures. Yes. Any question again?
And the $2 signs, what do they mean?
Yeah, the amount, dollar.
We have two.
Yeah, we have the debit side and the credit side. This is the debit and this is the credit side. For every transaction, there's always going to be the debit side and the credit side. So for that's in accounting. We call it the principle of double entry. For every debit entry, there must be a corresponding credit entry. Do you have any other question?
No.
Thank you.
You're welcome.